Welcome to Iron Financial, where we help you forge a stronger portfolio. All right, let's get right into it. Today, we are stress testing Adecoagro, ticker AGRO. And the question is simple, but the answer is anything but. Is this company a solid steel-framed structure that you can confidently build a position on, or is it a financial trap, a beautifully painted facade that's about to collapse under its own weight, taking your capital down with it? This is about more than just one stock. It's about learning to spot the difference between a solid foundation and a fatal flaw. Let's dig in.
Okay, right off the bat, the market is sending you two completely different messages. And this is a classic setup, right? On one hand, you've got the headline, the big, shiny news from their latest earnings report. And man, it looks great. Revenue of almost $416 million, when the street was only looking for $372 million. That's a huge beat. They lost just 4 cents a share when everyone was bracing for a 9-cent loss. So naturally, the stock surged on heavy volume. This is the stuff that gets momentum traders excited. But then you look at what the professionals are saying. The consensus rating from Wall Street analysts? Reduce. Their average price target is $8.50, which is way below where the stock is trading right now. So you've got this massive tug of war. The crowd, hyped up on a good headline, is buying. The pros, who are supposed to be looking deeper, are telling you to sell. What gives?
Okay, so to figure that out, we've got to have a game plan, right? Here's our blueprint for today. First, we're going to keep digging into that conflicting signal. Then, we're going to build the bull case from the ground up, piece by piece, looking at all the solid construction. After that, well, we're going to bring in the demolition crew and start looking for the cracks in the bear case. Then we'll zero in on the company's single biggest move, what we're calling the Profertil gambit. From there, we go under the hood, stress test the financials, the real plumbing and wiring of this whole thing. And finally, we'll give you our verdict. Think of this as a full structural engineering report on a company, designed to help you make a smarter call.
Okay, let's do it. Let's build the bull case first. You can't tear something down until you understand how it was built in the first place and why so many people are optimistic. We are going to assemble the argument for AGRO brick by brick, starting with the raw power of its growth engine. This is the bull's vision.
And look at this chart right here. This is the load-bearing wall of the entire bull case. Back in 2018, this was an $811 million company. Now, they're pulling in nearly $1.5 billion in gross sales. This isn't just some one-off good year because of a lucky swing in commodity prices. We're talking about a sustained multi-year climb. They have nearly doubled their top line in just 6 years. For an agricultural company, which is always at the mercy of the weather and volatile markets, that kind of consistent growth is some seriously heavy lifting. It tells you their operations are strong. This is the steel frame of the bull argument.
And that growth isn't a one-trick pony. This is key. Look at this pie chart. They are not just a sugar company. They're not just a dairy farm. Sure, sugar and ethanol make up a big chunk, about 44% combined. But look at the rest. You've got huge businesses in rice and dairy at 17% and 19% respectively. And then they're rounded out with everything from soy and corn to peanuts. This is what we call structural stability. They've literally engineered resilience into the business model. If sugar prices tank, the dairy and rice businesses can help hold up the whole structure. Smart.
And management is backing this story with action. $67 million. That's not just talk. That's how much cash they returned to shareholders last year just through buybacks. A buyback is management voting with the company's own checkbook. They're basically shouting from the rooftops, "We think our stock is cheap and it's the best place for us to put our cash right now." It shows confidence and it helps out the remaining shareholders by boosting earnings per share. They aren't just telling you the building is solid, they're buying up more of it themselves. And for the people who own the stock, they're getting paid, and I mean paid. A 9.4% distribution yield. Let's be clear about what that means. The S&P 500 gets you what, maybe 1.5%? A 10-year Treasury bond, maybe 4.5%. This is a fire hose of cash coming right back to investors. It's not a promise of future growth, it's a real, tangible reward for believing in this company today. A yield this high tells you management is focused on shareholder returns.
And it's not just a one-time thing either. Check this out. 4 straight years of increasing that dividend. That tells you that crazy 9.4% yield isn't an accident or just the result of a falling stock price. No, it's a deliberate strategy backed by real, growing cash flow. They are reinforcing their commitment to shareholders year after year after year. That's how you build trust.
So who's buying into this story? It's not just you and me. The so-called smart money is getting in on this. We're talking Goldman Sachs upping their stake by almost 50%. You've got Jane Street, Invesco, Ameriprise. These are the titans. They have armies of analysts. They do their homework.
And their analysis says this structure is not only sound, but it's worth owning a whole lot more of. That is a very powerful endorsement and a strong way to cap off the bull case. Okay. That's a great story. A beautiful blueprint. Growth, diversification, massive buybacks, the smartest guys in the room piling in. It almost sounds too good to be true, doesn't it? And you know what we do at Iron Financial when something looks perfect? We put on the hard hat, grab a flashlight, and we go looking for the cracks. It's time to see what the bears are so freaked out about.
And the first crack is staring us right in the face. It's Wall Street itself. Just look at this breakdown. Out of 7 professional analysts covering the stock, just one, has a buy rating on it. The vast majority, 6 out of 7, are telling their clients to either hold what you've got or just sell it. The consensus is literally reduce. Remember, these aren't random people on the internet. This is their full-time job. And they see the same shiny growth charts we just did, and they're not buying it. You have to ask why. And, you don't even have to look hard to find the answer. This quote, this is from their own press release, the same one that had that big headline beat. You just have to read past the first paragraph. Pressured. Let's talk about what that really means. Lower commodities prices means they're getting paid less for their crops. Mixed productivity is a nice way of saying their farms aren't performing well. Higher costs means their profit margins are getting squeezed. Folks, that's the trifecta of bad news for a farming operation. That great fourth quarter is starting to look less like a turnaround and more like a fresh coat of paint on a rotting wall.
Whoa. Okay, now this is the smoking gun. This is what's keeping the analysts up at night. Their farming business, a core part of the company, right? It generated over $100 million in profit for the full year 2024. A huge engine for them. But look at the most recent quarter. It didn't just slow down, it went negative. It lost $1.4 million. That's not a small crack, people. That is a gaping hole in the foundation. Something is seriously broken here, and it's a complete reversal of profitability in a key segment.
All right, so we've got a problem, a big one. The long-term growth story looks great, but a key business segment is suddenly hemorrhaging cash. So what's management's move? Do they just patch the hole? No. They go out and make a massive, company-altering bet. They just bought a giant fertilizer company called Profertil. This is the gambit. This is them pushing all their chips into the middle of the table. This is a move that could save the whole project by creating a brand new profit engine, or it could bring the entire thing crashing down.
Now, before we look at the impact of this bet, you're going to see a term called pro forma. Don't let it scare you. All it means is as if. The company is just showing you what their financials would have looked like as if they had owned this new business for the entire year we're talking about. It's their way of showing you the new combined blueprint for the future. And this is why they pushed all their chips in. Look at this. On their own, Adecoagro's adjusted EBITDA was about $277 million. Not bad, but it was down from the year before, which confirms the problems the bears see. But with Profertil added in, on that as-if basis, that number jumps to $467 million. That's an increase of nearly 70%. You see the strategy now? They are literally buying a new engine to replace the one that's failing. They're bolting on a massive, profitable business to cover up the cracks and change the entire story overnight. And here's the sales pitch that comes with it. Urea prices are going up. Our biggest cost, natural gas, is locked in at a low price. It's a recipe for massive profits. It sounds perfect, right? Maybe a little too perfect. Is this a realistic forecast, or is it just a great story they're telling investors? Remember, they just took on a mountain of new debt to do this. They have to integrate a totally new business in a new market. And they have to do it all while their old business is still struggling. The blueprint looks fantastic, but the construction phase, that's where big projects fail. He's absolutely right, and that's our cue. It's time to stop looking at the pretty architectural drawings and get under the hood of this thing. We need to do a full stress test on the balance sheet. Can the financial chassis of this company actually support the massive new weight of this acquisition and the new debt that comes with it? Let's find out. And you know what? When we run the numbers, it's surprisingly solid. A current ratio of 2.8, that's very strong. It means they have plenty of short-term assets to cover their short-term bills. The quick ratio, which is even stricter, is still a very healthy 1.56. They can pay their bills. And the debt? Even after this huge purchase, their debt to equity is manageable, and their net leverage is only 1.2 times their annual earnings. That's not dangerous at all. From a purely structural standpoint, the numbers say the foundation can handle the load. The wiring is up to code.
But hold on, if the balance sheet is so solid, then why are the pros so bearish? And that brings us to the great valuation puzzle. This is the heart of the whole debate. On one side, you have a price-to-earnings ratio of over 47. Based on their recent earnings, that screams expensive. You're paying a huge premium. But then, You look at the price-to-book ratio and it's less than 1. That means you could theoretically buy the whole company, all its land, farms, and machines, for less than what they say it's all worth on paper. So which is it? Is it an overpriced stock with weak earnings, or a bargain bin deal on hard assets?
And that's exactly the question we need to settle. We've seen the bull case, strong as steel. We've seen the bear case, some deep, worrying cracks. We've analyzed their huge, high-stakes bet to fix it all. And we've stress-tested the numbers on the balance sheet. Now it's time. Let's put it all together and issue the final verdict on the structure of AGRO.
So it all comes down to this, doesn't it? After the full inspection, after seeing the good, the bad, and the ambitious, is this structure truly built to last? Or are you about to sign a mortgage on a building that looks great today but could be condemned tomorrow?
Okay, here's the final blueprint from Iron Financial. Adecoagro is what we call a special situation. This is not a straightforward buy or sell. It's a structural turnaround play, and it is definitely not for everybody. This is an opportunity, but only for a certain kind of investor. We're talking about someone with a long-term horizon, 3 to 5 years at least. Someone with a high tolerance for risk, specifically the risk that this big merger doesn't go smoothly. And you have to be a believer in their Profertil story. On the flip side, this is a potential trap for anyone looking for stability and safety. This is not a stock you can just buy and forget about. It's a trap for anyone who needs strong performance in the short term. And it is absolutely a trap if you are not willing to underwrite the very real political and currency risks of investing in South America.
So there you have it. The engineer's report is in. We've shown you the solid steel beams, and we've pointed out the visible cracks in the concrete. The choice of whether to invest is really a choice about what kind of structures you want in your own portfolio. Are you building for steady reliability, or are you willing to take on a high-risk, high-reward renovation project? At the end of the day, we always say the same thing here. Your portfolio is your fortress. Build it wisely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.